Hello, this is Jordan, and this is your precious metals market update. This video is being recorded on the late afternoon of Good Friday, April 14th, 2017. And in this video update, I'm going to talk about where the precious metals sector stands right now. And starting off, let's talk about what is currently driving the sector and driving it higher as far as the last week or two. And the bond market in the last week or so has been whipsawing people recently, because at first it looked like the bond market was threatening to break below key support, and here we have the 10-year yield, and that key support level is 2.30 on the 10-year. And last Friday, a week ago, the market traded below it and then made a huge bullish reversal. But in the past week, that reversal just reversed in effect, and the 10-year went from about 240 all the way down to 2.23%. So now it appears that it has broken that support, and the question is, where's the next support? There's very thin support at about 220, and then the next support after that is around 210 or slightly below. And close to that, we have the 200-day moving average, which is rising, and that's at 2.04%. So the 10-year closed at 2.23%. I see more downside in the short term before we get some kind of rebound. And I think the exact same thing can be said about the S&P 500. And the stock market has been correcting since early March. And at the end of this past week, it broke below the 50-day moving average for the first time since the election, or since slightly before the election, and or slightly after the election. And where's the next support for the S&P 500? It looks to be at 2275, or maybe it could go a little lower to 2230, which is where the 200-day moving average is. So it looks like there's a good chance it could test the 200-day moving average. So in the very short term, the strength that we've seen in precious metals could continue, because both of these markets, their outlook for the very short term looks like it will support precious metals. Now, eventually, if these get oversold, they'll have some kind of a bounce, and that's when you can get a precious metals correction. Now, let's talk about how gold is performing against all asset classes, or at least various asset classes. And these are always my favorite charts to look at. I mean, look at gold against a basket of foreign currencies, and that is just the inverse of the US dollar index basket. And I mean, it was actually weak a couple weeks ago, but it's been very strong since then. It's very close to the 2016 summer highs. I mean, really within probably 2% or so. But also, look how close it is to the 2011 high. I mean, if we were comparing this on the scale of the gold US dollar price, which is close to 1290, I mean, on that scale, this scale, or that scale, I should say, I mean, it's probably at like 1750 an ounce, which just, and you can look at the chart, and it bottomed at the very end of 2013. So, interestingly, the gold against foreign currencies, that's been rising for more than 3 years. And so that looks really healthy. That's a good sign. Similarly, gold against the stock market, the NYSE, I like using that because it's a very broad index. I also look at gold against the global market basket, and the chart really looks the same, where we had a double bottom in 2015, and it looks like in the last 5-6 months or so, it made another double bottom. So with the bird's eye view, gold against the stock market has made a major double bottom. Well, I mean, it has made, but to really confirm that, we need to see it break above the red resistance there. Again, I'm looking at the middle chart here, but with the way that looks, it looks like gold against stocks have seen, I mean, that ratio has made a major bottom and could trend higher for years and years. But as far as the here and now, we need to see it break above that red line. That would be the first really good sign. The second really good sign would see it breaking above that peak in January or early February 2016. And when gold surged against the stocks in the end of December, early January 2016, I mean, that was a catalyst for the juniors and the rest of the sector. I mean, silver starting to perform much better. So it's always a good sign when gold outperforms the stock market. and we're seeing that develop here. And look at gold against bonds, gold against the 30-year bond. That has come down a little bit in the last week or two, but before that, it was trading at a 2.5-year high. So the fact that gold is showing so much strength against these other asset classes, I mean, this is the type of catalyst that you see, before real bull markets begin. And it's just a very good sign for the sector because it shows that it's really moving on its own merits. And this is not a geopolitical move or a US dollar weakness move. So I love to see that. Now, let's zoom in and look at where gold is now with respect to technicals. I see strong resistance at 1300 to 1310. So gold closing near 1289. 1294 is where that resistance starts. So there's not even though we should be more optimistic about gold given the fact that it's trended higher, it broke above the 200-day at 1262. It even broke above what I call the Trump resistance and the 38 or 62% retracement around 1278. So that was very encouraging. Even though it's done those things, I don't see this particular move going past 1300 to 1310. But it's just a very good sign that we were able to get above 1262 and 1278. So look for a little bit more upside, then we probably get some selling that comes into play. But look at the moving averages, which are about to cross. Here I'm showing the 80-week and the 160-week, and those are the equivalent of the 20-month and 40-month moving averages. Now on the monthly chart, they're about to cross, but they have not yet. I do have a feeling once we get into the next month, and there's another month added to the calculation, that we will see those moving averages cross. Now, a lot of people use moving average crosses, but there's a couple things to just simplify it, just what you need to know about moving average crosses. Number one, they're really a confirming indicator. They're not a leading indicator. And I'll get back to that in a second. The second thing is you want the moving averages to be going in the direction of the trend. You want them to either, I mean, if you're looking for a bear market, or you're looking for more of a downtrend, you want the moving averages to be falling as they're crossing. And in this case, we want them to be rising, sloping upward as they cross. And that's looks to be what we're seeing here. I mean, the one in red, the 160 week, that is very close to rising, whereas the 80 week that's been rising since early 2016. And so this is really a confirming indicator. I mean, as long as gold holds above 1200 to 1220, then this cross here is legit, and it's confirming that gold is in a new primary bull market. And this cross that we're looking at here, as far as the 20 and 40 month, the only times that's happened in this bullish instance, the bullish crossing, 1978, 1984, 1986. 1994 and 2002. So there's 5 instances of this cross happening, and the only one that was a false signal was 1984. So it's a very positive thing. And so the only thing that could derail this is if gold were to fall below 1200 to 1220. But again, as long as it holds above that over the next couple months, this cross is bullish and totally legit. The last thing on this chart is the volatility. We have 2 volatility indicators at the bottom, the GVZ, that's actually a contract, and then the ATR, the average true range indicator. When volatility is very low, it typically leads to high volatility, but you never know when that's going to happen. I mean, it can happen suddenly, it can happen slowly, the volatility can turn around and start to build. But the thing to note is that when volatility is fairly low, and that's usually precipitated by the market consolidating, not moving in big ranges. And so when the volatility gets really low, then it starts to give way to more volatile moves, bigger moves, can be in either direction. And so we showed some instances here. We highlighted 4 or 5 times when the volatility got really low and when gold made a big move. And most of these were down because we're looking at the bear market years. But if you go back and you look at 2001 to 2012, there's many instances when volatility got low, and then the market broke out, and its next big move was higher. And so, eventually this could lead to, I mean, if we see gold at some point in the months ahead rally up to that 1350 and then consolidate for a couple more months, I mean, that is just going to even build more energy and build more potential for that massive breakout. But again, where we are here and now, volatility is starting to increase, but there is resistance at 1300 to 1310. Now here, we're looking at the daily bar charts of GDX, GDXJ at the bottom. In the middle is my number 2 junior gold index. My number 1 junior gold index is it's similar to GDXJ. It has larger companies in there. The median market cap is around 500 million, whereas the number 2, the median market cap is around 100 million. About almost half the index are companies that I own. Okay, so if gold has a little bit more upside, what does that mean for the mining stocks? Well, GDX, I mean, that looks like it has a chance to get up to about 25.5, the November and February highs. Similarly, the same can be said for our index there in the middle. We covered this actually in a flash update, and I believe the index on, I forgot how much our index was up on Friday, but I think it was up 3 or 4% or so. But we were looking at around 275 as 275 to 280 as a resistance target. So a little bit more upside in that. GDXJ, I mean, that's a whole nother conversation. There was an article in Bloomberg. GDXJ is getting too big. There's too much money going into it, and so the fund, they're buying too large of stakes in these junior companies, and even recently they've had to invest in bigger companies that are not really juniors. I mean, they even own a position in GDX. So GDXJ is really losing its effectiveness as far as tracking the junior sector, in my opinion. And GDXJ is based on some MVIS index, and I actually looked at that index, and that is a chart going back to 2004. And I mean, a year ago at the bottom, that index was trading at a 12-year low. So Rick Rule once said, if you buy the index, you're going to get killed. And that's true. Over time, look, you can make a lot of money if you can time GDXJ right and you get in at the right level. Maybe you can hold it for a couple years. But over the long term, you really need to buy a basket of juniors and kind of manage your own GDXJ. I'm getting a little bit off topic here. But GDXJ over the last week or two, I mean, we because of this problem that Bloomberg was talking about, maybe a lot of big holders have been dumping their GDXJ, and it's been giving a false signal. I mean, it looks like in the last week or so, I've been pointing to GDXJ being so weak, but that could be a false signal because of this arbitrary selling. It's not really fundamental-based selling. So it'll be interesting to see how GDXJ pans out here in the very short term, but I have a feeling it'll bounce back, but I certainly wouldn't bet on that. Now, this recent strength that we've had over the last week or two, if we can just push up a little bit more here, that could potentially, well, it really reduces the risk of testing the December lows in the miners. That's something I've been worried about. And so now I would say, as far as GDX, maybe the strong support has moved, if GDX, again, can get up to that February and November high, then the strong support, in my opinion, the realistic test of strong support could be the 400-day moving average at around 2140. So that's the level I would focus on and not the December low. So if this rally continues a little bit more, that's a good sign in my opinion. It's basically moving strong support higher. Now, getting into the weekly setup for GDX and GDXJ, I remember talking about this in my last video. I said that I was bearish, but I would need to see a weekly close above certain levels to change my view, and that did happen. It did happen last week for GDX, but not for GDXJ. By last week, I mean 2 weeks ago. And we see the stark divergence this week where GDX was up 4.5% and GDXJ was barely higher. It would be a really good sign if we see GDX rally up to that strong resistance around 26. As we know, as I've shown on the chart, that's really the strongest resistance left. It's much stronger resistance than the 2016 highs. And so if the miners are able to rally up to that point, I mean, that would be 3 times it's touched that in the last 8-9 months versus only 1 time testing the rising 80-week moving average. And of course, after the December low, the miners rallied up that February high. They tested the resistance and they corrected a little bit, and now they have a chance to go back and test resistance again. And so if they make it there, that would be a really good sign that we're getting closer and closer to a big breakout in the sector. But still, I don't think we're about to see a major breakout begin right now. I think the bullish outlook would be we consolidate in the summer, and then potentially you get a chance for the big breakout move to begin at the end of summer, early fall. That's all for this video. Thank you so much for sticking with it all the way till the end. You can follow all my work at thedailygold.com. You can also consider my premium newsletter. Go to thedailygold.com/premium. It's only $149 for 6 months. That costs less than $1 a day. We focus on market timing and stock selection in the junior miners. And to make a lot of money, you really have to be in the right companies. We have contacts in the industry. We talk to geologists. I mean, we do our own research, but we talk to many people. In addition to that, we find out which companies, which deposits have the legitimate potential and which are just moving on hype and false promotion. And there's a lot of that, and people can get hurt by following that and not knowing what they're doing. Look at Northern Dynasty recently. That's one example. A lot of people lost a lot of money on that, buying in at the wrong time. Our model portfolio is a real brokerage portfolio. Everything we buy, it's a buy for ourselves. So we're just trying to make money and nothing else. Thank you again for listening and watching this video. I really appreciate it, and I look forward to publishing another video update for you in the next week or two. Thank you.